So I'm going to talk a little fast. There's a lot of stuff I want to cover. Oop, where's the intro slide? There we go. I'm going to talk a little bit about the state of the markets and the eras that we're in, where we've been, where we're going to. I'm going to talk a little bit about the election, of course, and what happened. And I'm going to make a little bit of a pitch for value stocks and high income stocks. That's a bit of a bias because that's basically what we focus on is income investments. And then I'm going to have a little bit of a digression and talk about disinformation, especially after the election that we've had, because there's a key lesson in there for all investors that I think is worth reminding. And then there's a whole bunch of slides at the back about equity characteristics that we probably won't have time to talk about. Okay, so I can't see my stuff here, so I'm going to just get my look around a little bit. So we've been through two eras recently. In COVID, we went through this era where interest rates were low, and you had dividend yields get higher than treasury yields, so suddenly dividend-paying stocks were super attractive. The economy was still recovering, everything was cheap, and value and yield stocks led the markets higher. In fact, at that point in time, we were outperforming the indexes by like 20%. And then as the Fed started raising rates in 22, it didn't really have an effect until 23, and then suddenly the market changed and went into the next year, and this was the era where normally Fed tightening bites and takes markets down. However, because of the advent of artificial intelligence that was usable, suddenly you had this burst in technology stocks. So while economic growth was slowing down, despite all the money printing from the government, you had a situation where the stock market was going higher, mostly led by AI and growth stocks. So there are two charts under there that are worth noting. One is that the change in interest, dividends versus interest rates, and you can see where it flipped, where interest went above. And then it shows global value stocks had their second worst year ever relative to growth. Now, as you guys all know, value stocks outperform growth stocks more often than not. But this past year, actually this past 18 months, has been the worst relative performance ever. So here's another chart you guys are probably familiar with. It shows how narrow the market is. The Magnificent Seven stocks and so forth have made it so that if you look at this bull market versus the last four bull markets we had, the yellow line on the bottom basically shows that this bull market has been the most narrow, so that the average stock has underperformed the indices by 20% or more. That's never happened before. So now we're evolving into this third era, this era of what we call falling rates and deregulation. And there's this nice little seesaw chart on the bottom. It's a reminder that when interest rates fall, asset values tend to go up. So the Fed's easing. We've got 75 basis points. The dot plots, as we'll show you in a second, expect another 100 basis points. Yields are gradually regaining significance, and we're going to talk about that. And the economy is going to recover. One of the biggest events that happened was this election, because suddenly you went from the most oppressive regulatory administration in U.S. history to one that promises to be the least. Just to give you some talk, and I'm not trying to be political, but if you look on Bloomberg Law, you'll see that the Biden administration had 12 lawsuits blocking deals. That's more than the U.S. had in the prior 20 years. The average processing time to review a deal went from 2 months to 9 months. So basically, the gears of progress on Wall Street came to a halt, and now they're opening up again in a big way. And that's one of the reasons why you've seen bank stocks take off and smaller cap stocks take off. Not only are they more rate sensitive, but they're very much more regulatorily sensitive. So this is the other big thing to keep in mind. This chart is slightly dated. It's from the end of August, but there was $6.3 trillion of cash sitting on the sidelines, happily earning 5%, essentially risk-free, and that was actually a real rate of return. If you look at the long-term rate of inflation, it's typically 3.9%, not the 2% they keep talking about. You're actually getting a real rate of return. But what's going to happen when interest rates go down to 3%, which is where they're forecast to go by the end of next year? All that money that was happy getting a risk-free 5% rate is not going to be happy getting 3% or less in cash. It's going to have to go somewhere else. And that's the opportunity for all of us. So this is another chart that supports what's to come. Every time the Fed has cut rates, it's been fantastic for stocks. In fact, 93% of the time they've gone up meaningfully. And if you look at the data, value stocks outperform growth stocks 100% of the time during those eras and have gone up 100% of the time. I like to bet on things when you can win 100% of the time. At least that's what the track record is. I don't know about you guys. But we're not there yet. We're still in this transitional period we talked about. The economy is slowing down, so you're seeing it in the negative earnings revisions, and there'll be some charts on that. GDP is still good, but it's slowing down. It's going to take some time, just like it took a year after the Fed was hiking rates to put the brakes really on the economy. It's going to take at least another 6 months of history as a guide before the rate cuts start to lift things up. So we're going to see some more negative guide downs in not only the third quarter results we're seeing, we're going to see it in the fourth quarter, and maybe a little in the first quarter before things tail up. Markets know that, and that's why you're seeing multiples expand as people buy ahead because they see what's coming down the pike. These are the dot plots. You can see the Fed basically says we're going to cut another 100 basis points, but the real excitement, and you guys should pay attention to this slide, you see the short end of the curve is all bent. It's like those commercials you see on TV. You have Peyronie's disease. Anyway, what it means is these guys are going to cut the rates, and by the middle of the year, if you can believe the Fed guides and you look at the chart, we're going to have a normally shaped yield curve, which means carry trades will work. And that's really great for planning, which means that companies are going to be able to borrow short and lend long again consistently and not have all these bends in the curve that screw things up. And as you know, when that happens, lending picks up. Next thing, we're still in the transition. The big one is the PMI chart. You see manufacturing PMI down 23 months. That's also a record. But if you look at those gray bars on the left and you see how they tail up, this is an ISM chart. So the forecasts are that we're going to see a massive acceleration in manufacturing. It's not just the reshoring. It's the fact that companies have CapEx issues. So we should talk a little bit about COVID shutdown. So what was the COVID shutdown policy was? It was the United States government destroying a lot of businesses. You make people that can't go to work, capacity gets destroyed, and you have shortages. And when you have shortages, and we all know supply and demand, it helps create inflation. The other thing that helps create inflation was money printing, and they did both. So normally when you have a recession, it's one of surplus, too much capacity. And then you have to cut back the capacity and reach an equilibrium so that the economy can grow again. We didn't have that this time around. The closest period in history was in the 1940s after World War II, when we shifted from making war goods to making consumer goods. There was this tremendous shortage of consumer goods. There was massive inflation, and it took a couple of years to solve the problem. And once we did, we had this era of growth that lasted basically for, I'd say, 12, 13 years. So that's kind of why this time is different. And that's why you can see the manufacturing taking off, because there's still shortages that need to be filled. Also, you notice the negative revisions. Companies have been beating their numbers for 70% of the time, but they've been cutting guidance just as often. And that's been a negative on the market, particularly on cyclical stocks. Value versus growth. There's two quick charts here that just show the history of value beating growth consistently and in magnitude. This is a good chart from JP Morgan Asset Management, one of the sponsors. And it basically shows where interest rates are. If you look at the chart in the middle, it's an attractive period for value stocks. So value is cheap versus growth. And we've also established when the Fed cuts rates, it helps value stocks. And basically you have a situation where this growth spurt, where everybody's focusing on the growth stocks and ignoring the value stocks, is going to change. And this shows you what's working. Basically, AI technology is working and rate sensitives are working. Utilities have had a big burst, not just because rates are falling, but because we're short electricity, and it's part of that capacity that we need to build out. But the bigger chart that's important is the black box, which basically shows the expected growth rates for the AI tech stocks are coming down, and the growth rates expected for the cyclical stocks are going up. So people are happy to pay 60 times earnings for something scarce and rare that's growing when nothing else is. They're not going to pay 60 times earnings for things that are not growing much more than other things that trade at 12 to 14 times earnings. So that's part of the flip. As you get further out, which basically happens at the end of the first quarter, you're going to see a situation where I think the AI craze is going to crash, or at least people are going to pull money out of there and say there's not much upside left, and they're going to start buying cyclicals. So this is the outlook chart. There's a bunch of stuff in here. So we think the Fed's going to cut rates. It's going to help, as we talked about. The economy is going to continue to slow for the next quarter or two, even though in anticipation of the growth, stocks and bonds are going to do fine. Trump deregulation is a huge positive. It's freeing up investments, so we're going to see CapEx expanding materially. The big thing with the Trump trade you hear a lot of in the media is the anxiety over the tariffs. Obviously, there's a lot of bias in that. A lot of people in the media are unhappy over the outcome. But if you look when Trump raised tariffs last time, it had a zero effect. And that's because the Chinese did eat all the tariffs. So how much of this is negotiation? How much of this really happens? We don't know. But right now, all those stocks are getting pressured down and creating an attractive entry point if we have a repeat of what happened last time, which was it wasn't as bad as feared. So we also have a situation where we've gone for leadership that was a little nebulous to leadership that is a little more scary and firmer. And that actually historically has created less exogenous shocks from foreign activities. So I don't think he's going to be able to cure the war in Ukraine in a day, or he's going to do half the things that he said. But I do think there's going to be more anxiety about people causing trouble because they're afraid of what he might do. We also expect, as we said before, the long-awaited rotation out of the AI names into others will continue. And then on the next chart, we have just the case for the dividend stocks. The new era has dawned. Lower rates, deregulation, it's good for everything. Dividend-paying stocks historically have outperformed in situations like this. They should do so again. We talked about these things before. Since February 23, it's been a one-way market. And they've got a bit of a bubble in these tech names. I don't think that will last. Valuation disparity is high. And we have to make a pitch for dividends and yields. Basically, people need money. And the type of investors that typically invest in the stuff that Sound Income does, our clients or advisors, their clients are often retirees. They can't afford to not get yield. So they're going to buy bonds and they're going to buy stocks because they need the income. And that's going to become more relevant. And there's going to be a chase for that. So this is a little commercial for us. Basically what we do is we help advisors run their businesses. We do websites, we do sales coaching and things like that. I'm in the asset management side. So we invest money for advisors who do a great job gathering assets, but they don't feel comfortable buying and selling stocks and bonds. The best thing that we try to do is have a differentiated product. So we have a couple of ETFs as well. We did these ETFs originally as loss leaders for our clients that didn't have enough money to have the separately managed accounts. And now we're trying to make them a more broadly distributed product. The one that I run is Divvy, which is the dividend equity fund. We have a 4.5% dividend yield. It's trading, average P is like 10.8, 11 times earnings, so it's cheaper than everything else. If you look at the earnings growth rate, it's about the same as the market. So you're getting the same earnings, you're getting 3 times the dividend rate, and half the valuation. So usually that works out. It's been great for for 3 years. It was great, and the last year and a half it's been terrible. But it's concentrated 35 stocks. It hasn't changed, and once again, I think it's the right time for this. Now, I've got this digression. This is where I go off the rails a bit. I was just in Florida at a conference, and everybody wanted to talk about the election. That's all they care about. And that's a more technical crowd, so they really want to get into the details and the weeds. But one of the things that jumped out of the election is that we live in an age of disinformation. I mean, basically, if you looked at the campaigns, both sides were lying through their teeth, right? So that reminds me of one of the first things you learn on Wall Street as an investor is to basically not listen to what anybody says. The only things you care about are facts or axiomatic things that can prove to you what's true and what isn't, because everybody's spinning and trying to tell you something. So these slides basically talk about that. But basically, everybody's trying to sell you something and convince you that what's good for them is good for you. And more often than not, it's not. So some of the things they say are true, some are not, but you can't really tell. But in your mind, because if we've all studied behavioralism, we log those things in and we say, well, we don't know if they're true or not, but we heard it, so it's probably true. But we don't have fact checkers in the real world, and if we did, we probably wouldn't listen to them. So we're filling our minds with pollution when we listen to all this stuff, and that is the kiss of death. So always think when somebody's telling you something, even whether it's me here who's basically trying to sell you on the idea that our products are going to do well, or anybody in the media, that they have a bias, they have a point of view, and it's not your point of view. You can accept it or not, but everybody who's talking to you should analyze them even before they open their mouth and say, where are they coming from? What's their angle? What's their agenda? And basically say, I'm not going to believe anything they're going to say. I'm going to try to cull the facts from what they're saying, not the spin. So I use the example of media firms. You know, media companies are not in the business of telling you the truth. They're not even in the business of entertaining you. They're in the business of selling your eyeballs to advertisers. That's what they do. Everything they're about is to sell you to somebody else. So don't think they're in it for you. And that came out clearly in the election. And then I go into my little monologue about how we were told for months it was a tight race, neck and neck. It looks like the Democrats are in the lead. Pay attention, when if you actually looked at some of the betting sites where people were putting real money on it, it was pretty clear. It wasn't close. And the betting sites, if you look, have a history going back to 1860, and they've been right 93% of the time. The media has been right less than half the time. So, but we were told not to listen to that. And then we get the outcome and we realize we've been gaslit again the whole time. You know, everybody who's telling you something has an agenda, whether it's on the right or on the left, but it's not yours. So this is a great example to pay attention. And, you know, we all love Elon Musk, and there's this other guy, Ray Dalio, who made a few dollars too, and they both say the same message. They both talk about getting back to first principles, which basically means just what I've been saying: tune out everything. Everybody who's talking to you, try to figure out where they're coming from, why they're saying what they're saying. It's not for your best interest. I don't care how nice they are, how much they feed you. They're doing it because it's good for them. So try to separate the facts from the noise. Getting back to first principles is looking at every situation and trying to figure out what's real and what isn't, and know that what they're telling you is spun. So I use some examples just to say, you use this stuff to explain, to derive the truth, to project what's going to happen, and this is what I tried to do with my slides with the evidence. An example is when interest rates fall, the cost of money goes down. That means the price of everything goes down. Don't let the spin doctors confuse you with, you know, past, you know, rate movements, and this is what the Fed means with their body language. It's all bullshit. It's really simple. When interest rates go down, everything gets cheaper. Your purchasing power just went up. You got wealthier. You're going to buy more stuff. And that's basically it. Supply and demand works. All the other spinning around it is just to confuse you. This is a little bit probably too complicated because I've got 4 factors and 2 conclusions, but basically every asset trades on a spread to treasuries, a risk-free rate, and people are risk averse. So when you can get a real return in cash, it makes perfect sense. Everybody's going to put their money in cash, and no matter how good your sales pitch is for stocks or bonds or whatever. And when that changes, they're going to change too. And investors will always overpay for quality due to risk aversion. These are sort of axioms that you can derive from your economics classes, whether it's at Framingham or Rutgers or wherever you are. But it's true. That's much more reliable than anything you're going to read in the newspaper. So base your decisions on that. And we can go on. Now, I have a bunch of slides here. I don't think, I don't know if I'm talking too long. If we have a time to go over them. These are just some facts. 2 minutes? All right, forget it. I'm going to stop talking. You can read these later. The slides are available to everybody. But what I want to do is get some engaging questions. I want you people to tell me I'm full of crap and ask me questions to show me that you listened to the lesson and you're going back to, you know, core principles in the economics or in whatever. So go ahead, rip me apart. Let's go. Come on, don't be afraid. Yes, young lady. Okay, the AI question, how's it going to change our productivity and is it priced in? So AI has been around for 50 years, basically. It's basically a new form of automation. It's a little smarter. It's not really smart, but it does a few things. It allows you to replace people with machines, and that's why AI is so hot, because ChatGPT and others have added a level of performance functionality. So basically it means that if you have a lower level information or client services job, you just lost it, you just don't know it yet. So it is definitely going to help productivity, but the quality will go down. Don't you guys love it when you call on the phone and it gives you this endless menu sequence? If you want to do this, do that. And then you waste hours to get a simple question answered, or if you go on the online and you do go through the AI bot and it does nothing for you except for waste your time. So it's definitely improving and it's definitely going to save money, but it's always evolving. So the enthusiasm came when you could yourself do creative content with AI, which you couldn't do before. And it really does save people who have to write all the time or create even media all the time. It saves them tremendous amount of time. I can't quantify that. I haven't studied it enough, but it's real. I'm not against AI. I'm against the over-extrapolation of what is going to be spent on it versus what people spend the rest of their money on. But it's real, and it's going to be there for the rest of our lives. So, you know, in my life, I've tried it. It doesn't work for me, but it will. It's getting better. And the people that do media in our company use it a lot, especially for client service. So, yes?
How about sustainability? Where does that fit in, especially in the light of new policies?
Can you define what you mean by sustainability? Well, you've got me there because I've actually studied this subject a little bit, and I'm a climate change skeptic. So I've studied this. I literally went to the Inconvenient Truth opening and met Al Gore and talked to him many times and all these people. So there's 0.4% of the atmosphere is actually carbon dioxide. And you think that going from 0.35 to 0.45 is going to change the temperature of the Earth by 10 degrees? I don't. And then when I was at the table in the opening with a bunch of, you know, basically college professors, because those are the people I try to hang out with when they'll suffer me, they all tried to ask questions, and there were nobody who could answer their questions, and they were shut down. And at that time, the Royal Academy of Science said, this is politics, this is not science, and they banned the film in the UK. And even when I was at Oxford, they didn't allow that film to be shown except for in political science. Now it's become accepted. So the question isn't whether the climate has gotten 1.8 degrees Celsius warmer over the last 100 years. The question is what's causing it, and they don't really know. So the pushback on it, I think, has been wrong. I think the pushback should be, let's find out the truth, instead of accept the policies and then say, therefore, we're going to tax carbon because that funds everything else that's on our agenda, and rather figure out what we can do about it. I don't know if you've ever read the Freakonomics books. Have you read those? There's an excellent, this was going back before climate change became religion, and there's an excellent piece about a bunch of guys in the University of Washington. They said, well, if you look at volcanoes, or if you look at water in the atmosphere, every time a volcano comes off, it spews tons of carbon dioxide and particulate into the atmosphere, and the temperature of the Earth drops by 3 degrees for a couple of years, like Mount, Pinatubo when it did that. And they use other examples in the Pacific Northwest because it's a temperate rainforest, and when it rains a lot, the temperature goes down, and it's just moisture in the air. It doesn't have to be raining. But they basically said they could change the temperature of the Earth by several degrees just by misting water. But nobody's planting more trees to create carbon sinks. Nobody's doing any of these things because there's too much political will to be gotten by scaring the shit out of people and saying, hey, the world is coming to an end if you don't do what we say, so people get in line. The same thing is true for a lot of other things. And that's how politics work. People scare you to death to get you to do what they want you to do. It goes back to that same thing I was telling you about before. Do your own work and make up your own mind. I study this a lot because, when I first heard about it, which was even before Al Gore did his movie, I said, it doesn't make sense, but I want to understand it. Because if you remember in the 1970s, and I don't know if you're too young to probably remember the 1970s, but there was a period of time when they thought the climate was cooling. In fact, the temperatures, if you look at the data, actually went up for 15 years, went down. And that was a much more polluted time than we have now. And there was a book that came out, and I forgot it was Erdman or one of these guys, about how we're getting the next ice age. For those of you who are old, they don't remember that. And then it gradually changed because there was this guy, this scientist, billions and billions of things he talked about. And he was a big believer in greenhouse gases, and it was his view that it was real, and I have no doubt it's real. It's just a matter of, is that what's causing it? And that I don't know. So getting back to the companies will do it because they're forced to do it. They're not going to do it because it's in their economic best interest, because it's costing money for something they're not likely to get a return on. Now, a lot of the energy companies are doing it because of the incentives. They have to do it, and they can charge a premium because there's a scarcity of it. So if the government regulations change, though, you'll see much less of it because it's just not as economically helpful as say, fossil fuels for most of it. Now, wind and solar are good things, but they're just not quite as economic. You know, wind is great if the wind is blowing, but you always have to supplement that with extra batteries and other things to make it work. I don't know if that was too much of a digression, but.
How about a round of applause?
All right.